Good evening, ladies and gentlemen. On behalf of State Bank of India, it gives me great pleasure in welcoming all of you who are present here, including analysts, our colleagues, and in fact, analysts and our colleagues are joining this analyst meet through video conference from Mumbai. I would extend a very warm welcome to them also. And I also extend a very warm welcome to those people who are attending this through live webcast, on the eve of declaration of the Q4 and FY17 results of the bank. We have with us, before we proceed with the question and answers, I would like to first introduce the dignitaries on the dais. We have with us on the stage our chairman, Srimati Arundhati Bhattacharya at the center. And to her right is our Managing Director, Corporate Banking Group, Shri B. Sriram. And to her left is our Managing Director, National Banking Group, Shri Rajneesh Kumar. Our Managing Director, Compliance and Risk, Praveen Kumar Gupta, is seated next to B. Sriram. And our Managing Director, Associates Subsidiary, Shri Dinesh Kara, is seated next to Rajneesh Kumar. And our Deputy Managing Director and Chief Financial Officer, Srimati Anshula Kant, is seated next to Shri P.K. Gupta. We have amidst us the Deputy Managing Directors heading various verticals, Managing Directors of our subsidiaries, and Chief General Managers from various business departments and verticals. Again, once again, welcome, extend warm welcome to all of you to this. And then now, the sequence of events will be, our chairman will make opening remarks with the help of a presentation, highlighting the performance of the bank for the Q4 and FY17. And thereafter, we shall go for the question and answer session. And before I do that, I would like to read out the safe harbor for the presentation. Certain statements in these slides which are going to be presented are forward-looking statements. These statements are based on management's current expectations and are subject to uncertainty and changes in circumstances. Actual results may differ materially from those included in these statements due to a variety of factors. All financials and other information in these slides, other than financial and other information for specific subsidiaries where specifically mentioned, is on an unconsolidated basis of SBI only, unless specifically stated to be on a consolidated basis for SBI Group. Please also refer to the statement of unconsolidated, consolidated and segmental results required by Indian regulations, and that has, along with these slides, been filed with the stock exchanges in India. Over to Chairman Ma'am.
Good afternoon and welcome to this analyst presentation for the 2016-17 results. First of all, let me say that this is indeed a historic day. Historic because this is the last analyst meet that we will have for SBI Solo. Also because for the first time SBI Solo has managed to do more than 50,000 crores of operating profits. That's a very large number, and the fact that we have done it on our own is indeed something that we should remember. Having said that, once with the merger done, we are now among the top 50 banks globally, both in terms of assets as well as in terms of Tier 1 capital. We are now 4 times as large as our next competitor in the Indian banking segment. Also globally, we are the second largest banks in respect of a physical reach, with our 24,000 branches, more than 59,000 ATMs, serving 420 million customers. We are definitely having a physical reach that is unparalleled. However, even though the physical reach is very large, our reach on the online space is nothing to not mention, because that itself is also very, very huge, in the sense that today SBI Online is the world's 5th most visited bank website. We continue to remain market leaders in those areas of home and auto loan segments, which in India today are still underpenetrated, and we believe are areas where everybody is interested in ensuring that they have better market share. One other area just quickly wanted to mention was the fact that from this year onwards, we will be preparing a sustainability report based on the GRI international standards, because we believe the fact that we have been around for so long, that is 210 or 11 long years, is by design and not by luck. And these are based on certain practices, sustainability practices that we have had. And we would like to report on these on a regular basis so as to ensure that this unbroken record of profits and dividends that we have for over 100 years, that this continues. So if we look at the Q4 on Q4 numbers, just a few data points that are interesting. The net interest income in Q4 on Q4 has gone up by 17.33%. In respect of while interest on the deposits is contained at 8.61%, it is interesting because the actual growth of deposits, however, has been something like 18.14% YOY. Similarly, in the non-interest income, in the quarter concerned, though there is a slight dip YOY, this is on account of certain one-time income, specifically the repatriation of overseas profits, which currently we are not allowed to take into the P&L and which were not there in any case this year. That is the reason why quarter on quarter there seems to be a little bit of a fall. In respect of operating expenses, the cost to income ratio has come down by 138 basis points to 47.75% during FY17. This is an area that we have clearly shown that we have been able to restrain operating expenses. Operating profit on quarter has gone up by 12.93%. The loan loss provisions are down by 9.44%, not because we have not made enough, but merely because last quarter was a quarter where we saw the peak of slippages, and therefore the loan loss provisions were huge during the last quarter. However, even in this quarter, we have made more than adequate loan loss provisions, as I will tell you as we go along in the slides. Profit after tax, if you consider quarter on quarter, has gone up by 122.72%. And it has doubled despite a 2.19% increase that we have done in the total provisions. As I said, the total provisions have indeed increased. In respect of the YOY, net interest income has grown by 8.16%. The non-interest income, and this is what I wanted to say, that though there was a quarterly aberration, but if you look at the whole year, it has grown by 27.35%. And if we take out all of the one-time items in both of the years, because last year, as I said, there was repatriation of profits. This year, for instance, there was the sale of non-core assets in respect of the stake sale in Life and the NSE. Therefore, if you take out all of those, even then, the non-interest income has grown very robustly at 22.5%. The operating expenses YOY is 11.23%. Cost to income, as I've already told you, has already come down. And why the operating expenses are slightly higher, that also I will detail as we go forward. The operating profit YOY is up at a very healthy 17.55%. And as I said, we have now crossed the Rubicon in the sense that the operating profits are now at 50,848 crores. Loan loss provisions have gone up by 19.50%. And here we want to specifically mention that our PCR has increased by a humongous 526 basis points, while net NPA actually is down by 10 basis points YOY. Profit after tax, if you look at YOY, it is up by 5.36%. The area of interest is this growth in cross-sell income. The CAGR has been at 38.9%. The quarter on quarter, it is around 44.5%, and YOY, it is at 58.61%. Actually, the share of our cross-sell income to non-interest income, which is ex-treasury, has increased from 2% to 3% during this year. But this is one area which we tend to increase significantly going forward. We are at this point in time in the midst of a project called Project Impact, which is basically a customer relationship management project. And this is being implemented to leverage the data analytics so that we can customize the sales and ensure that our people know what is to be sold to whom. There is another project which we have named Project Lotus. This is basically to provide an omni-channel experience for customers on a single digital platform. Again, the deliveries of this will start sometime in July and August, and we expect that this should be complete by July of 2018. And it is expected to be able to provide a really different and a differentiated experience to our people, to our customers on the digital platform. Our number of wealth management centers have increased significantly from 9 to 14, or rather they will increase significantly from 9 to 14 during FY18. This is an initiative that till now has been doing quite well. It is an initiative to which we intend to roll out pan-India, and we expect that this is also something that will add to our income. 42 crore of our existing customers are being actively targeted for the greater wallet share. And again, the digitization of internal processes, around 200 processes currently are being end-to-end digitized so as to enable us to release people who are currently in the servicing area and to redeploy them into the sales area. In respect of ORCA recovery, one area that we thought that we had put a lot of emphasis on and which needs to be therefore discussed, we have over the period 2016, the growth has been 21.6%. But if you consider recovery, upgrade and ORCA, the total of that this year is something like 12,101, which is around 22% more than what happened last year. This initiative is going to be scaled up even further, and high-value ORCA accounts have been adopted for recovery by our top executives. The scheme for one-time settlement in both SME and agri term loan is gaining a lot of traction, and we are now targeting around 75,000 cases for resolution of NPA and ORCA, actively being pursued, all of these cases, and we expect many of these will materialize during the current year. The sustained CASA growth that has been driving our liability franchise is something that we have managed to build upon during this year. Total deposits went up by 18.14%. And what we would like to mention over here, that even before the demonetization, it was increasing at, what was the percentage? At around 15%, 16%. So even before the demonetization, the growth in savings bank was around 16%. So during the year, we have gained about 38 basis points of market share. We have opened around 3.5 crore new savings bank accounts, and the average balance in these accounts have improved by around 5,000, more than 5,000 rupees on an average. We have also opened a large number of corporate salary packages during this year. We have about 90 lakhs of these corporate salary package accounts, which have an average balance of more than 50,000. In respect of current accounts as well, the number of accounts during the year that we have opened is in excess of 22 lakhs. The asset portfolio on the other side also, we just wanted to give a feel as to actually what has been the growth in assets. We have declared a growth on the domestic side of 7.92. But if you actually take out the base effect, and this is why we just put together this slide, which is a little unconventional, but to explain what is the base effect. This year, as you know, food credit in the industry itself has come down hugely. Around 46,000 crores of food credit in the industry has been replaced by loans given by the small saving schemes of the Government of India. Now, as a result, this has impacted our bank by about 17,000 crores has gone out from the base. And therefore, if you adjust that in the base, actually speaking, our domestic advances have actually increased by 9.545%. Add on to that the fact that, you know, during the year, we have gone up in commercial paper by about 45,000 crores and corporate bond by about 18,000 crores. If you work that into the whole thing also, then growth is actually as much as something like 14.07%. Now, in respect of foreign offices, our advances had gone up by 7.27%, but here also there is, as you know, the special FCNB scheme was wound down during this year, and as a result, the loans riding on that particular deposit has also wound down, and that is to the extent of 12,000 crores. So if you compare all of that, overall the advances growth is actually in the range of 13.83%. The loan portfolio is very well diversified, as you are aware, and this year actually even on the loan side, we have gained about 65 basis points. In respect of retail, we continue to grow very strongly at in excess of 21%. In respect of capital again, we remain very well capitalized. March 16, we had closed with 13.12. At that point of time, our tier 1 was 9.92. Today we have closed at 13.11, that is 1 basis points down. Tier 1 has actually improved to 10.35. And we have also indicated that the source for capital has been varied. One, of course, is the retained earnings itself. And of course, there has been some amount of infusion by the Government of India. But we have also realized quite a bit of our non-core assets to the extent of 2,662 crores. We have raised AT1 capital of 9,100 crores, as well as there is a revaluation reserve impact that has come in over here to the extent about 14,900 crores. Now, the matter that is something of great interest to most analysts is in respect of our NPAs. And here I think, the lower portion of the slide is particularly something which the CFO also drew attention to in the media interaction, and I would also like to draw your attention to. Specifically in respect of provision coverage ratio. Provision coverage ratio, as you see, has gone up to 65.95%. And in fact, even without, if you take out the OCA piece, even then it is as much as 48.13%. In respect of the credit cost, we had given a guidance that we would try to keep it at around 1.8. Here, of course, it is more elevated. One of the reasons for that is we have made provisions to the extent of around 1672 crores, in addition to what was mandated as per the regulations, because we believe these are units which are on the verge of resolution and may need additional provisioning. This is in order to take care of that. The slippage ratio, if you compare to FY16, has of course halved, but even then it is still a little elevated. We expect this to also come down over a period of time. As such, your gross NPAs has gone up from YOY from FY16 by 40 basis points. But if you look at quarter 3, sequentially it is down. Similarly, your net NPA ratio, it is not only down sequentially, but it is also down YOY by 10 basis points. In respect of the impaired assets, because there has been a little uptick on the restructured standard, where I think the food credit of a particular unit has got added. But over and above that, if you look at it, the gross NPA plus restructured standard is currently at 9.16. The net NPA plus net standard restructured is around 6%. In respect of the SDR and the S4A numbers, we have given the numbers over here. In respect of the S4A, though the number is 5,935, the amount implemented at this point of time is only 888 crores. We continue to hold very high provisions in respect of our stress standard assets. This is over and above the mandated 5% provision. This is in addition to that, we hold around 5,910 crores, plus the counter-cyclical provision buffer continues at 1149 crores. Next, we come to the watch list. This quarter too, the amount of slippages from the watch list is around 70%. Overall, during the year, the amount of slippages from the watch list is around 72%. Currently, we have revised the watch list. This is the only post-merger number that we are giving here. This is a number that is given after taking into account the corporate book of the merged entities. And here you will find that the number is at around 32,427 as opposed to around 34,776 solo of last year. Also, if you see the little blurbs on top, Last year, this amount was 2.3% of our asset book. This year, this 32,000 is around 1.6% of our asset book. Of this 32,427, 9,801 pertains to our erstwhile ABs, 22,626 pertains to us. The increase that has happened is in two major sectors. One sector is telecom, the other sector is power. One of the reasons why we have put these in the power sector is because there are certain projects that are now going to get completed during this year, but still don't have PPAs. Those are units that we have put over there. During the last year, they were under construction and therefore they were not here. And this year too, while we do not know whether they should be here, but because they do not have PPAs, we thought it prudent that they should be included here. The risk profile of the corporate is constantly improving. If you look at the lavender columns, which shows the stock of A-rated connections and PSUs and A-rated connections and above, that has gone from 55 in March 15 to 72 as of March 17. But of better interest is the blue columns, which shows the new connections, and that has gone from 61 to 84%. So 84% of our new connections are actually A-rated or above, or they are PSUs and well-rated PSUs. In respect of what has been done in order to improve this asset quality, we have given a number of things over here which we have actually done, including the early sanction review, the loan review mechanism, the early warning system, the dynamic rating review, legal audit, etc. that has been implemented. The independent risk advisory now also has been completely implemented. And today the entire emphasis, both at the time of budgeting as well as the time of taking on of any new connection, is basically on the basis of the returns that we get on these accounts rather than based on top line growth. In respect of the personal segment, this is now 30% of the domestic loan book, growing very strongly and becoming better. If you look at the NPA ratios of the home loans, they have improved from 0.51 to 0.53. The average TAT in our home loans is now down from 16 days to 11 days. 35% of this is in the priority sector. Similarly, in respect of auto loans, the NPA ratios are stable. There has been quite a bit of market share gain in autos as we are growing at 21%. So market share has gone from 25.21 to 27.16. In respect of other P segment loans too, the NPA ratios have actually come down. Plus, we continue to have very good growth in this portfolio, given the fact that these are loans normally made to the account holders of our salaried accounts. This portfolio also is not only a very good yield, high yield portfolio, but also is behaving very well. In respect of Agri, if you look at FY13, at the time when I came in, the NPAs of this particular portfolio was at 9.39. Today, in spite of all the headwinds, this portfolio NPA has come down by 386 basis points from FY13 to 5.53%. We expect that this portfolio in the next 2 to 3 years will come down to an NPA of less than 3%. And towards that end, we are doing a large number of things. Not only are we now focusing on the risk mitigated products such as agri gold loan, asset backed loan, produce marketing loan, etc., or tractor loan under tie-ups, but we are also focusing on cash flow based financing through tripartite agreements and farm to fork financing. And this is the reason why we find that this portfolio at this point of time is a stable one, it's growing, and it is actually showing NPA ratios that are coming down steadily. In respect of SME again, this is a portfolio that has actually become lesser portion of our entire asset portfolio. One of the reasons for that is over the last 3 years, we've actually been consolidating in this area. But I think at this point of time, we will look at growing this more aggressively. We have put in place a large number of enablers over here to ensure that the growth is properly risk mitigated. We have done 2 very large projects. one for the way the marketing is required to be done and another for the underwriting piece. And we believe here too you will see that the NPAs will come down. During the year, the NPAs have come down in this portfolio to the extent of 78 basis points. Our international banking has also been a very, very good story. We did have some regulatory challenges across the world in many areas. Today, all of those are behind us. The asset quality is improving quite consistently. In the entire asset piece, we have a higher share of long-term loans, and this will have a positive impact on the NIIs. We have now reduced dependence on India-linked loans, so that compensates to some extent to the sluggish growth demand in India, credit growth demand in India. And we have currently about $3.8 billion in medium and long-term funds that we have raised during this year at very, very competitive rates. This also is expected to boost the net interest income. 79% of the investments that we have made are in the investment grade assets as on March 17, as against only 75% as on March 16. So here again there is more emphasis on quality rather than quantity. And the gross and net NPA of this segment are both down by 55 and 34 basis points respectively. There is a continued focus on NPA resolution. The sale of core and non-core assets by corporates during this year, the amount that we have realized our share is as much as 4,778 crores. The restructuring under S4A, as I said, was 5,935. However, of this, only 888 are implemented at this point of time. Restructuring under SDR was 4,281. And the recoveries on account of ERCs, both ARCs and e-auctions is around 5,610 crores. Now, we would also just like to give a small data point that the top 50 NPAs constitute about 48% of our total NPAs. And various resolution mechanisms are being actively pursued in order to ensure that these accounts get resolved as quickly as possible. The next segment, again, very quickly, I want to take you through this because this is our journey towards a totally new bank with a very robust IT infrastructure and with a very large growth potential. Today, the amount of IT infrastructure we have created, there is enough redundancy. We are only using about 25% of the database and the application servers and only about 50% of our memory. If you look at our IT infrastructure today, we have the capacity to handle more than 15,000 transactions per second. We currently handle about 4,600. On the first day of this financial year, we handled more than 146 million transactions with more than 66,000 concurrent users at any point of time. We are able to host more than 2 billion accounts. In addition, we have the biggest private cloud in the APAC region. We are currently in the process of building several platforms, as we told you, under Project Lotus and Project Impact, which again will start delivering on the customized personal journeys by the middle of this year. And further, we are also doing a lot of digitization in the corporate banking space as well as for the CMP products. Our Security Operations Center is ISO certified, as also our data center. I just talked about digitization of 200 processes end to end. We believe with this, the redeployment of our people from sales to marketing will definitely be enhanced. Similarly, the cost to income ratios also are definitely going to come down. The kind of service requests that we have given a little chart down below. If you have it, you can have a look at it. This is where we believe these are the areas that are getting digitized and which will release the maximum number of our people. We continue to remain a very dominant player in the digital space. 77% of our transactions are going through the alternate channels. Go to the next one. Yeah, going through the alternate channels, only about 23% of the transactions come to the branches. Our debit card spends this year has gone up 2.32 times. POS transactions have increased by 2.5 times. And as you can see, if you look at the number of our ATMs, our POS, the group debit cards, etc., we have much more than our logical share of the market if you compare the share that we have in the deposits with the actual number of shares in these transactions, you can see that we are definitely one of the most dominant players in this area. In respect of the synergies that we have for the merged entity, and I know this is of great interest, today, once this is all merged, and this is as of the 1st of April that we have cast this particular number, our total deposits will be 25,85,320. CASA ratio will still remain very healthy at 44.40. Remember, all of these entities had much lower CASA than us, but when you put it all together, whereas our CASA was 45.88, but even then the merged CASA will be very healthy at 44.80. Total advances will be 18,68,000. Market share of the deposits will go up from 18.05 to 23.07. In advances, it will go up from 17.02 to 21.16. The number of branches, staff, and the number of customers we have given. The gross NPA ratio, if you just do a simple addition, will come to around 9.11. But the net NPA ratio, even of the merged entity, will remain at 5.19. This is important because, as you know, at 6% of net NPA, the PCA kicks in, so we are far below that even at this point. The provision coverage ratio, which we took up to 65.95%, when you do the merged balance sheet, comes to around 61.53%. The slippage ratio is, of course, much higher at 5.78 because most of the AQR adjustment in respect of the APs has happened this year because their AQR list was very small, and that has been adjusted to our AQR list, and therefore the slippage obviously has been much larger during this current year. And the credit cost is around 2.9. In respect of capital, a lot of people have worries on this count. I would like to say that instead of 13.11, if you do the merger as it is right now, it will come to around 12.85, still very well capitalized, especially if you look at Tier 1, which is at 10.05. The Government of India's shareholding will be at 60.75. The cost to income ratio will go up from the 47% we had to about 49.45, and we will work to bring this down. The cost of deposits is at 5.91. This is something which we expect going forward will come down given the fact that the ABs had deposits which were sourced at rates higher than ours. The yield on advances, if you put the merged entity together, is 9.31, and the domestic NIM at 2.90. Now, quickly to give you some of the synergies of the merger, not only will we be a stronger and larger financial conglomerate, but there will be an elimination of a lot of redundancies such as corporate offices, treasuries, administrative setups, IT, etc. The common treasury processing centers, IT infrastructure, they will not only reduce costs, but they should also actually improve our profits. Because as you know, the treasury in SBI had a portfolio yield that was sometimes as much as 90 basis points above that we were receiving in the smaller treasuries. Similarly, I already pointed out the cost of funds will come down. But I think this is very important, this improved availability of skilled manpower, and we have given a chart over there to show the gaps that we had in manpower and how now that is getting addressed because of this merger. Remember that when we are doing the merger, the people who are becoming available to us are people who served in treasuries, people who serve for the corporate advances, and normally in any institution you will find that the more skilled people are put in these areas. Therefore, there is a whole lot of very skilled people which we will now be able to deploy in our new initiatives of things like wealth management, SME advances, digitization. So therefore, to that extent, this is one area where I think we will have a very good impact of the merger. And of course, the new initiatives that we were not able to roll out simultaneously to them, currently we will be able to roll out into the entire bank. One very quick look at the subsidiaries and where they are. Today our subsidiaries are doing very, very well. As you know, the SBI Life, we sold a small stake at 3.54 times the book value. This year, their profits have increased to 955 crores from 861 crores. They have also received the Life Insurance Company of the Year and the Bancassurance Leader Life Insurance Awards from Fintellect. If you look at any of their areas, whether it be new business premium, they are growing at almost 2 times the market. If you look at their ratios in respect of persistency, both 13 and 61 months, they are doing exceptionally well. 13 month, I think they are on the top of the industry. In respect of mis-sell complaints, they are at the very bottom at 0.20%. So in every other ratio that you can look at, they are doing exceptionally well. The same is the case in respect of many of our other subsidiaries, and we have given some little points over here. SBI Cards, SBI Mutual Fund. If you look at the ROEs in this respect, they are doing very well. SBI Cards has an ROE of 29.5 and SBI Mutual Funds of 29.6. SBI Cards has come from number 4 position to number 2 position during the year. Funds management is at number 5 position. Similarly, with SBI Capital Markets, they are doing much better today in the area of debt as well as equity issues. SBI General Insurance during the year has turned into black. They have given a profit during the whole of this year and expected to do very well going forward. One other very small point wanted to make, that SBI is the sponsor bank of 18 RRBs, in which it has around 35% stake. Now, some of these RRBs are doing exceptionally well. Why we are mentioning this is, today in the market there is humongous valuation being given to small banks. We already have 18 small operating banks. Today, we have now given the responsibility of all of these RRBs to our associates and subsidiaries department, which has now got some additional bandwidth because the associates are merged and they no longer have the responsibility for that. And they have been given the responsibilities of these RRBs of hand-holding them to see how best these can be brought to market, because some of them are doing exceptionally well, and with the right kind of guidance, these are units that can do very, very well. In fact, in respect of 2 of them, we have written to the government as well, but definitely we will look at ensuring that the operations of these units really come up in respect of efficiencies and productivities, and thereafter we would like to showcase these going forward. We have given a little bit on the strategic investments that we had, because we keep receiving questions and queries on these. So to that extent, this has been given, nothing to discuss over here. But overall, I believe this has been a very, very challenging, very exciting quarter for us. In respect of the merger, I would like to say that though it happened on the 1st of April and the current thing is going on, at this point of time, I think most of the customers have not even felt that anything has happened, and yet the merger has taken place. And this is not by chance again, it is by design. There is a lot of work that our IT department has done in order to ensure the seamless kind of merger that we have managed to do. And to that extent, you know, it is one of its kind in the entire industry. So going forward, we believe that we have done quite a bit in order to de-stress the balance sheet, to take adequate provisions in every which way. In respect of the associates, the erstwhile associates, we do have some amount of expenses in this current quarter in respect of the VRS, but even there, 75% of those expenses we have already taken as an upfront provision. We don't expect to set aside anything very much for this particular initiative. Maybe around 100 to 200 crores on the outside is what we will need. But this amount is also taken in this quarter's results. So to that extent, you know, we have done everything possible to ensure that the next year we start on a clean slate and that we give you the kind of results that are expected from SBI for a very long time, and which going forward we expect that we will be able to do. So with that, I think I will end my comments. They are a little extended this time. You will forgive me, because this is probably the last time that I will do the complete results. So we did want to explore some of the areas that we have been working on. Plus we did have the merger, and there was some amount of comments that was required on that. But other than that, we are now open for questions. So anybody has any questions, kindly go ahead.
Thank you very much, ma'am. In fact, we have questions, we will seek questions from this hall as well as from Mumbai. We will alternate between these two centers, and then a couple of questions we can seek from here, and then a couple of questions we will take from Mumbai. I would request each one of you who are going to ask question to specify your name and then the organization you represent. So we will start with this hall. Analyst from this hall can, anybody who want to ask question, you can start the question.
Yeah. Hi, ma'am. Congratulations. This is Vishal Goyal from UBS.
Yes, Vishal.
Clearly tough times for banks. I think, ma'am, you while you are refraining from giving guidance on NPL formation, if you look at last year, we had 20,000 crore slippages from the watch list and roughly 20,000 plus from outside watch list.
No, 70%, around, yeah, retail, right.
Correct.
Around 70% is from the watch list.
Yeah.
70% of the watch list slip.
Exactly.
You see,
Yes,
the
you are right, around
watch list
20,000.
was about 34,000.
Yeah.
But there is guidance given last time that we had slippages would be about 40,000.
Yeah,
And
correct.
we were within that 40,000 as per whatever.
It was as per the guidance
Yeah, yeah.
given. We had clearly guided for 40,000 last year.
Absolutely.
Yeah.
You were actually within the guidance.
That's
I
right.
think the
See,
question is.
even within that, I'll just share with you, 9,400 odd crores is from the SME Agri and Per out of the total. So when we talk about 70% plus slippages from the watch list, that is only referring to the corporate slippages.
Correct. So I think, ma'am, actually I am talking like the broad numbers that 20,000 from watch list and balance from outside watch list.
That's right, that's
and we have again like 33,000 roughly of watch list for the next year. So outside the watch list slippage, do we expect the run rate to continue, or that should at least decline?
Outside?
So what I mean is
Retail
non-corporate. What I mean is like, for example,
Retail
20,000.
piece, retail piece.
Yeah, retail, agri, SME.
Yeah, retail is roughly 9,000 crore. It is around that, and the portfolio is now increasing. And post-merger, the retail portfolio we define as housing loan, personal loans, SME up to 50 crore, and the agriculture piece. So about 9,000 crore is a number which I don't think is going to decrease substantially. So that is the slippage, and our recovery effort continues. So on the retail side, you can safely assume that 9 to 10,000 crore.
See, the thing is, it's very difficult right now to
Yeah.
say, because retail is also dependent on a few things happening. Today, for instance, I have a larger workforce, which if I can deploy properly, I will probably be able to put more effort. And retail, as you are aware, it's effort elastic. The more people you put on the ground, the more things happen. Now, this deployment will happen in the next 90 days. It doesn't happen on day one of the merger. So I need a little time. In fact, these are two areas where the deployment will occur. One is in the area of recovery, another is in the area of sales. Okay, so the maximum deployment of whatever manpower we can get will be in these two areas. And if you look at that, if I throw more manpower at the same problem, hopefully we will get things better. And overall, if you look at sentiment wise, other than the IT sector where there seems to be job losses, but over and above that, if you look at sentiment, and we had a customers meet in this venue itself yesterday, the sentiment seems to be better. Now, if the sentiment is better, I would say the slippages will come down. Okay. Now, if there is more problem in the industrial sector, in the economy, then well, there could be issues. But over and above that, I think, directionally, we are on an upswing.
Situation is under control.
Yeah. And getting better.
And ma'am, in the international loan book, NP actually has gone down. So what is basically that is an upgrade recovery or something happened there?
IBG book.
No, NPA has gone down due to two factors. One is, of course, that there has been some recovery. There has been some transfer to the domestic book from the international book as well, because of crystallization of the NPA here in the rupee side, and also it's much easier to resolve when it is all aggregated in the Indian domestic context.
Okay, thank you, ma'am. All the
Thank
best.
you. Thank you. Yep.
Sorry, would you be able to share the number of net worth of associate banks?
The number of
The net worth of associate
Net worth.
banks?
net worth.
Yeah, the shareholders fund.
Network.
Oh, shareholders fund. Do you have the number?
they become our shareholders.
Yeah, so basically they are our shareholders. I don't know how to give that separately.
can separately talk to you and understand what you want to get.
Shareholders funds, just the shareholders funds of the associate banks, the
Don't often have the number because now they are merged with ours.
See, basically of the associate banks, 2 of them were 100% ours. So the capital just comes, means, otherwise it was getting cancelled out at the group level. Now, the same thing happens. It comes in and gets cancelled. And in respect of the other 3, they were majority owned by us, only about 10%, and some were a little more than 10% were outside. The rest were all ours. So it is part of the group capital, now it is part of our capital, that's all.
Okay, and in the watch list, in
Yeah.
the consolidated watch list
Right.
of 324 billion,
Right.
the power exposure of 110, how much belonged to the associate banks and how much
I'll
would?
tell you, I have the number.
Power is 8,520 is the SBI number, and 2,555 is the associate banks.
Okay.
Okay?
Yes, and just one more question. Again on this subsidiaries only, would you be able to share the net loss of the subsidiaries for the full year or fourth quarter, whichever?
We can share the net number, but actually speaking, if you plus minus, in any case, you'll get it. The entire year, it was around 11,866. Okay?
Thank you so much.
Now we'll take a couple of questions from Mumbai. Anybody in Mumbai?
Yes, sir.
Yes, please.
ma'am. This is Manish Oswal from Nirmal Bang Securities.
Yes, please.
My question on next year, given the watch list book size and the aging portfolio of the current stock of NPA, how do you see the credit cost compared to FY17 at March there?
See, again, the credit cost during FY18 will remain a little elevated. I don't think it is something that will go down during FY18, mainly because we are hoping that the resolutions will come during this period. If there are resolutions, there will have to be upfront provisions taken. And that is the reason why we cannot say that directionally it will come down. But having said that, I think FY19 will be a very good year. So to that extent, I think credit cost wise, FY19 is the year that we should look out for a deceleration and bettering of the credit cost. Okay.
Okay. And second, on the margin side, domestic margin side, how do you see the margin? Because corporate side there is a pressure on the yield. So how do you see that?
See, on the margin side, there are some opposing pressures. The opposing pressures are like this. On the one hand side, you do have the credit cost, that is the corporate, the NPA piece where you might need more provision. So there is a pressure there. Plus, we are not sure how many of these we will be able to book the interest on, even on the piece where we are doing the resolution. So we have to be a little cautious about that particular piece. But on the other side, as the AB's deposits reprice, we will be getting some amount of relief on the cost of funds there. The other thing that the CFO was just pointing out in the other conference is that today we have excess SLR to the extent of how much, Anshula? 5% excess SLR. Now, as the credit growth goes up, and we are expecting it to grow up during the year, as that goes up, we will definitely see more and more of these funds getting deployed into credit. And there, the moment it goes into credit, there is a yield pickup of around 200 basis points. So that is again something that should actually add to our margins. So if you put all of this net, I believe that we will be sort of able to hold it stable. And that's where we see it at this point of time.
Thank you, ma'am.
Thank you.
Anybody else in Mumbai?
Hello,
Yes, please.
ma'am, just want to know. Hello?
Yes,
I
yes.
want to know
Yeah.
what's the outlook on the cost to income ratio post the merger to be settling for the FY 18 and 19?
See, cost to income ratio, the idea is that we will try and bring it down. Again, you know, we have been saying that in the medium term, we will try and bring it down substantially. At this point of time, I think in the near term, because we have brought it down, but well, because of the AB's merger and they had a higher, slightly higher cost structure, therefore to that extent it has gone up. But the endeavor will be to try and again, you know, bring it in line with our glide path. So we should see a downward bias on that.
And out of this top 50 accounts, which you mentioned standing 4.9% of your advances, how much is the total outstanding provision on that?
The provision on that would be around 41%.
Can I get the outstanding SR?
No, there is no SR there. These are actually, basically, these are accounts that are sitting in our books on which many of these are operating units, and these are accounts on which we have just done these provisions. So there is no SR in this. These are actually NPA accounts, not yet resolved, under resolution. Not sold. Not sold.
Outstanding security receipt on books?
Outstanding SR on our books. Okay, we'll give you the number. We'll just find the number and give it to you. Yeah.
We'll take questions from here now.
So it's 5,568 crores.
Okay, so outstanding SRs are 5,568 crores.
Hello.
Yeah.
Yeah, madam, this is Shubhrata from Dalmia Securities.
Yeah.
Just the outlook from your side, like after merger, like power will be single most stress area for us. So particularly because of more exposure to all associates. So like all these steps which has been taken, means after the last two also decision, like regarding coal linkage, and particularly when like ACB can pass on the coal linkage to bring down their cost. So after that, what is like your outlook on particularly stressed asset on power sector?
Yes, so power, we have today about 146,000 crores of exposure, and of which about 40% of that is on PSUs and what we feel strong discoms. Another 40% is where we have investment grade power holdings, of investment grade companies there. So balance, it's the ones that are concerned is the balance 20%, which works out to about 30,000 crores. Now, out of that 30,000 crores, we already have identified or rather classified about 4,000 odd as NPLs. That leaves us with about 25,000 crores. Now, 25,000 crores, there are various stages. At some point, there are some completed projects which are not in investment grade. There are projects under construction, which at least today, at the time when it will take another 2 years to complete. So those things have been left out. And out of those deep down analysis that we have done, we have found that about 11,000 crores is the ones that needs a little bit of attention. Basically, on the purpose of what you have said, one of the things that there is no PPA, the completed projects which are selling to the merchant, sustainability is into question. But we are trying to resolve some of these assets as well as we go on during the year. So while that goes simultaneously, we feel that there is an amount of 11,000 crores which is stressed, and that is what we have taken in our books. So the total thing is not more than 20 to 23,000 crores which needs to be seen, but of that also what we are saying is about 11,000 crores it requires currently more hand-holding.
Just a bookkeeping question, like I suppose this quarter employee cost has come down. Is it because of
employee cost?
Yes. Is it because of actuarial adjustment or?
No. There is no actuarial adjustment. Employee cost has come down basically on account of the fact that around 11,000 of our people have retired, and to that extent the amount of people who have joined is around 13,000 people. So the people who have retired are obviously at the top of their scales, the one who have joined are at the bottom of the scales, and the joining has been in the last 2 months of the year actually. So their cost is actually factored in only for the last bit. So that's the reason why it has come down. There is no actuarial adjustment.
So is this a one-off or this trend, at least in percentage terms, trend growth will be lower?
No, this is not a one-off. Actually, if you see FY16 and FY17, FY16 our contribution for employees was 5,907, FY17 at 6,071. So it is more or less stable. Okay. And similarly for salaries, if you look at the year, last year was 19,207, this year is 20,418. So it is basically under control. There is no one-off over here, there is no reversals or anything over here. And this trend is more or less what will happen. See, what will happen is this year again, I don't think we will be doing too many recruitments. At least on the clerical side, the recruitments will not be there this time. On the officers side, there will be some amount of recruitment, but that will come at the end of the year because we already have a little bit of an overflow from the associate banks. Now that overflow will be adjusted by the end of the year because around 13,000 people will retire by the end of the year, okay? And 3,600 have left on VRS. So to that extent, you know, this is more or less where we will be for this year also. It will not be anything very different.
Next question.
NPA for large and mid corporate Q1Q has gone up substantially, and close to 90% of our advances is NPA in mid corporate segment. So what is giving us confidence that in future things will be better?
What is that? Mid corporate?
90% of the...
What is 90%?
The NPAs come from mid corporate and large corporate.
47,000 is the NPA amount.
Which one is it talking about?
Which slide?
Just 1 minute.
80,000 out of 112. 87,000. What is your question?
Q1Q, the large corporate as well as mid corporate NPA has gone up. From 44,674 it has gone to 47,000, and large corporate is 27,000, 33,000.
Yeah. Yes.
No, we lost you.
So what is the question? We've lost you. We can't hear. We can't hear.
Yeah, go ahead.
Yeah. So what is giving us confidence that next year asset quality will be better in these segments?
Okay.
Asset quality will be...
Now, basically two things. One is that the, as I said, that the watch list of these corporate watch list is also trending downwards. If you remove the, out of the 32,000 crores, the ones that on account of associate banks, we are actually looking at about 22,000 crores from SBI. So the trend is going down in terms of the watch list there. The other part is, of course, that there are a few resolutions which are maturing, and we are quite optimistic that during the year we should be able to do these. And if that is done, quite a substantial chunk will get upgraded. So net on net, while the gross slippages, whatever we have been guiding is there, but net on net on the upgradations as well, you will find that one or two or more than that, if we are able to resolve big ones, and we are quite hopeful of that, we should be able to do it in the next 2-3 quarters. The upgrades will start to happen, and that will help us in reducing the NPL ratios.
See, one other thing we have to understand both in the large corporate and in the mid corporate. One of the reasons for the stress was the lack of demand in the economy itself, and the fact that there were other macroeconomic numbers, that were not in favor of things getting better. Today, if you look at India and the macroeconomic numbers, whether they be the fiscal deficit or the current account deficit or even the inflation numbers, they all look very good. The other thing that is happening is that in respect of the manufacturing units, in quite a few cases, we are beginning to see capacity utilization exceeding 70%. So if you look at power, if you look at cement, these are core industries again, which are actually doing much better. Now these do start doing better when your construction industry looks better. Similarly, because the metals, commodities across the globe are their prices are becoming a little more firm. So things like metals and mining is also beginning to look a little better. Now, as these segments of the economy start looking up, automatically the accounts in our books in respect of these particular sectors will obviously start performing better. So I think, overall, if you look at the direction of the economy, which way it is going, the overall direction is upwards. And so to that extent, there is belief that these particular segments, whatever weaknesses there were, much of it has already been recognized. The rest of it is under very close watch, and the remaining should be able to get through this difficult time and be able to perform quite well in the future.
Next question.
Ma'am, this is Amol from Wells Fargo.
Yeah.
Recently, you have made a comment that the whole recovery process of bad debts in India would take about 3 years to itself. What gives you the confidence, given the earlier schemes that were introduced, didn't yield satisfactory results? What gives you confidence that this 3 years would be enough to solve this matter? Do you think that there needs to be incrementally done by RBI, by the government or the other stakeholders that are involved in this?
Well, anything that is done incrementally will obviously be of a big advantage to all of us. But even otherwise, if you look at the Indian economy itself, as I explained to you, the Indian economy today seems poised to definitely start doing much better. Also, if you look at the government itself, the government is very focused on growth. And as the government takes a few big steps, such as GST, such as what they did for demonetization and for formalization of the economy, as well as for digitization of the economy, all of these are actually going to add to the productivity and efficiency of the economy itself. Further, if you look at the demography of India itself, there is a demographic pressure over there. Given that pressure, the government has come up with things like the Prime Minister Awas Yojana. Now, the Prime Minister Awas Yojana is actually a very well formulated scheme. It is well formulated because it clearly lays out houses for the lower middle class, not only for those people who can't afford anything at all, which is why originally when the amount was restricted to 12 lakhs, it didn't quite take off. Today it has gone up to 18 lakhs. And 18 lakhs is a decent amount for people, especially in tier 3, tier 4 cities. Not only that, what they have done is they have upfronted the subsidy. To that extent, the scheme has become so much more attractive. So, these sort of things that are being done by the government, plus, the number of projects that are now coming to bidding stage, whether they be in areas of roads, areas of transmission, areas of renewable, areas of mining, all of these coming together, we do believe that the economy is basically on the cusp of a growth phase again. And if that happens, I don't see any reason why all of these should not recover. Remember one thing, in India, much of these infrastructure and core sector projects are projects that will have demand. Today, the per capita utilization of power and steel is far less than what is globally the average. So in India, there is definitely a big scope for improving this per capita utilization of things like power and steel. And to that extent, therefore, ours is a country where the economy is actually growing. I therefore feel that whatever I have said is very reasonable. In fact, I have given a pretty long period of time. I personally would like it to happen much faster. It may not happen that quickly, but the fact remains that I think 2 to 3 years is a very fair amount of time to ensure that all of these accounts get back on track. There is a question here from Manisha of Taurus MF saying, what further steps can be expected from government and RBI to help resolve NPAs? How soon can we hear from them? Actually, this is a question that should be addressed to the government and the RBI. I really cannot speak on their behalf. We are hoping that they do give a helping hand, but exactly how much they will give and what they will do and when they will do it, this is really not something that I am in a position to answer.
We take questions from this hall.
Hello. Madam, again, Subrata, a follow-up question. Just this quarter, our growth is loan growth is quite decent.
Yes.
And you are also giving some good indication of the economy, which we are also tracking. So, any in this business, any guidance or any kind of ballpark number you want to give on loan growth for next year, and your on-ground experience from which sector we can expect. Any prominent sector or few prominent sector from where we can expect.
Talk about the sectors. Bata, kon sector? Retail.
See, there are two, three things that can happen. That's what. One is, of course, already we are witnessing loans, shifting between markets and the loan book. In the sense that the credit has started to flow between the two, depending on how fast things will happen. And also the instruments such as InvIT and REIT is going to give a lot of opportunities for some of these completed projects to get onto the markets. So while we are going to look at loan growth, we in the bank are also looking at consolidated growth from a customer, in the sense that either it be from the markets or from the loan book. So in that sense, I think we need to make sure that we achieve our targets in a combined basis, because most of the higher rated corporates will tend to, and also the higher rated public sector units will tend to migrate to the markets. So that is one thing. The second is there are certain areas that are upcoming and they require funding. Now how much, as we have said earlier also, as we drill down into the exact company's name rather than looking at the sectors may be stressed, but the companies may be good. And in that sense, what is our leeway in trying to increase our exposure in those sectors is something that we are looking at. It can be oil, gas. We have seen some petrochemical improvement in the exposure limit, the drawings of oil companies. We have chemicals and fertilizers. A couple of interests have come in both in brownfield projects as well. We have completed road projects. Renewable space is there. So there are certain sunrise projects which are coming up, and we'll be tapping them. The third area, of course, is within the industry is that credit flows from one bank to the other, depending on competition and depending on what sort of pricing we give. So in that sense, again, we find that we are pretty well competitive in terms of trying to get the best in the industry to try and improve our credit growth there. So all in all, I would imagine that some of these sectors are new credit. As I said, some businesses where we won't be showing it on our loan book, but more on the markets. If you've seen, I think 62,000 crores of increase has happened in the CPs and the NCDs over the last year, which is actually not factored. If you factor that in NPL ratios, it will be even more better, in most of the ratios that we have. But unfortunately, it is not. While there is a stopgap backup arrangement in the clients' accounts with us, because they are all carved out of the working capital limits as they go to the CPs. However, the benefit of that for some of our ratios is not available. So I would imagine that the growth will come from all these three scenarios. Yeah, in the corporate side, I don't think.
And on the retail side, in any case, our growth is very steady, diversified across all the portfolios. Home loan, in the post-merger scenario, amongst the bank, we would be, every third loan will be from State Bank of India, as the current position is.
Okay.
Auto loan has been growing at 21%, and the auto sector, particularly the car loan, the sales are picking up. Agriculture also, if the monsoons are good, as they were last year, so we saw a lot of growth and lot of new initiatives have been taken to improve the quality of the agriculture and the lending methods both. We have worked on both. And SME, again, a lot of initiatives have been taken to build that capacity. And two major projects about which Chairman spoke about. One is the marketing through what we call Project Vijaypath, and the balance sheet, moving away from balance sheet to cash flow based financing under Project Vivek. So retail story is intact, and the distribution reach now is further strengthened with the merger of the associate banks. And again, as Chairman was mentioning, that more people in the marketing and more people to keep an oversight on the credit quality. So on the retail side, we are assured that we will be able to grow and we will be able to maintain the asset quality.
Next one.
Yeah.
Yeah. For?
Madam, next year, loan.
No, I don't at this point of time want to give any ballpark figure. We'll see.
Oh,
Okay.
Yeah, this is Srishankar here,
From which organization?
from Prabhas Lada. Yeah. December, we are, from December to March, the significant increase in our credit offtake or advances. If I extrapolate on a consolidated level, that simply doesn't seem to be anything happening out there, which means that associate banks, have you seen actually a decrease in that side? That is the first question. And second one is, within this, is it working capital, or is there any new project loans, anything has actually resulted in increase?
What happened?
He wants to know, as to, if I am getting your question right, you want to know where the growth has come from in the
That's
Q4.
right.
Q4.
That's right.
Now, largely in Q4, there is generally a lot of business that is culminated. The efforts that happened over the last Q3 and Q4 post the results of most of the corporates, in terms of enhancements and increases in exposure limits. So that is one. Second is that the oil marketing companies had, as usual, they do draw on our limits, on their limits, so the last 15-20 days. The third is, of course, the area where we use, generally the subsidy, the fertilizer subsidy is due to be given to the companies, and we do front end that as loans to the companies, which is paid out sometime in the month of April, May. So these were the larger ones, and as I said, most of the draws also happened in the last quarter across, and that is the reason that there has been an increase in the Q4.
See, also one other thing was during the third quarter this year, we had absolutely almost nothing because of the demonetization. So all of that also got into the Q4 numbers. Demonetization ensured that, regular banking activities were almost negligible. So in fact, even on the retail space, whatever growth came rather, subsequently, post demonetization, rather than during the December quarter. So that also has skewed the December, this last quarter numbers a little bit.
Next
Yeah,
one.
on the consolidated level, there is a substantial decline in associate banks.
Consolidated level, I don't think we have Q4.
We don't have it
We
here.
don't have it.
You can talk to us separately, and I think our
We'll
Mr.
work
Katti
it
or
out
me
because
will
we
work
don't
it out.
have the consolidated level on Q4,
Thank you.
on the advances number.
Yeah, hi, Sachin Upadhyay from
Yeah.
ICICI Securities. Ma'am, just a couple of queries. If you could give us, top 50 account exposure on consolidated, NPAs that is there and their coverage, if that is possible. The other question is, in terms of overall yields for consolidated book, you have shown it at 9.31%. If SBI's MCLR now is prevalent across, how would these yields move through FY18?
Now, see, these would move only, as and when they reprice. So it's not something that's going to get repriced immediately. So depending upon as the accounts come up for review renewal, or if they opt for a change in MCLR, then it gets repriced accordingly.
So how much percentage of the loan book is?
It's
It is now at 50%.
So this is-
50% of our loan book is on MCLR and 50% is still on base rate.
And if you were to just kind of look at aging, what percentage by end of this year will actually kind of look at MCLR?
See, even if you remember when we spoke after the December results, we had shared that the percentage was 40%. Typically in the fourth quarter, a lot of review renewals happen, at which time many loans have moved from base rate to MCLR, so it has jumped by 10% in one quarter. Again, I think first half will be slow, it is very difficult to guess a number. And for the other retail people, they have to actually walk into the branch and pay a small switching fee to move to MCLR. And as the corporate or SME side, as the review renewals happen, they may. I would imagine since most of the review renewals happen at least once a year, much of it would have been done by now. It is mostly the retail book now that would be remaining and some fixed income loans.
Fair enough. And just last question is on, the 11,000 problem assets which are there in power sector. What would be your wallet share of this? What will be this 11,000?
I think about 8,000. 8,000 is ours.
No, so 8,000 is yours, but what will be the sector exposure?
Oh, acha, sector exposure.
6,000 is ours.
No, they are saying of this 11,000, what is the sector exposure of this? I have no idea. Means those accounts across the sector kitna hai? We don't know, frankly. Means we can find out, but we don't have the number here.
You can average it out.
Yeah.
5%.
Yeah, we would have about 30-35% probably of these
would be
accounts.
our accounts.
So roughly.
3 times maybe, 33, 35,000. Okay.
And the first question, in terms of top 50 accounts for consolidated.
We don't have that.
We
but,
don't have that because the top 50 for us were not the top 50 for them.
Ma'am, I have their top 50 now.
But that is what, our top 50 and their top 50 are not exactly contiguous. So we'll work that out and we'll let you know. Once, in the June quarter, in any case, everything gets merged. Then you can take our top 50 and take it as the total top 50.
Sure.
Okay?
Thank you.
Yeah.
Next.
Yeah, Manju.
For subsidiary banks for FY17?
We didn't
in their
provide-
balance sheet.
Okay, in
What
their-
did they provide in their balance sheet?
I think.
In their PNL, sorry.
See, I can just share with you one data point that, in the fourth quarter, for all the associate banks put together, I don't have the exact actuarial number, their contribution for employees was 1,000 crores plus, around 1,000 crores. Normally, they were doing about 400 to 500 crores per quarter before that.
Okay, and now it's 1,000.
So in that quarter they have taken, see, the idea was basically they should take all the expenses to catch up with wherever our bank was. So that has been done, and so we have tried to do for the loan loss provision and also for any other expense that could have been required soon after the merger. Yeah.
Okay, so it's 1,000 crore. No, I was just trying to.
For the full year it is 18,1873 crores. For all these 5 banks put together versus say 1183 last year. So that excess of 5,600 they've done in the fourth quarter.
Okay.
Yeah.
Got it. Thank you.
But there is nothing there that we need to do.
Right.
Okay? So those things have been all taken care of before the merger.
Also, even if you see the percentage of our employees now on defined contribution, it is now, number has gone up beyond 70,000. And it is about, 35% or so. And their proportion is also more or less similar.
No, their proportion is more.
They were on the higher side. They were at
There's
40%.
40% is already on it.
40% is on defined contribution. So going forward, it shouldn't be, it should be, usual as we are doing.
Again, ma'am, just one follow-up question on the ordinance. If you speak to a lot of banks, they believe that OCs are a given. So, is that So is that almost like a done thing, though the announcement has not been made?
We don't really know. Frankly speaking, the fact of the matter is that the OCs will be only required if the structure itself is relaxed to accommodate more accounts. Okay. Otherwise, today we already have an OC who is going through the S4A accounts. So if you have another OC or two more OCs, the only thing that can be done is those numbers can be expedited. But those numbers won't go up much because the current structures you can't take through the deep restructuring cases. So, and the OCs won't do something where there is no structure. They want a structure. So it's a kind of a difficult situation. So they will do the OCs only if they are willing to relax the structures. If the structures don't get relaxed, then I think the current OC will be able to manage. So we have to see how things pan out. It's difficult to say what exactly will be done.
And is it possible to get the outstanding numbers for 525 SDR?
I think we've given already, no?
SDR and S4.
SDR 525 क्या outstanding है बता दो?
Okay, sorry.
I'll give you that.
She can. It's
The outstanding in 525 is 24 accounts, 23,107. SDR is 10 accounts, 4,777. And S4A is 13 accounts, 7,863. I'm just giving you the fund-based limits.
But in that S4A, what sir is saying, maybe there may be some NPAs.
Yeah, the standard, yeah. This is the total, including standard we have 10 and we have S4A is about 6,348.
We've given the standard numbers here. Stress standard SDR is 4,281 and S4A is 5,935, of which implemented is 888.
Yes, 3 accounts.
Yeah.
But these are only standard accounts.
Standard
Sir,
accounts.
as the gross
Yeah.
figure.
Yeah.
Now, anyone from Mumbai?
Okay, otherwise here there was somebody, yeah.
Ma'am, another question on your associate banks. Last year, you had about 60,000 crores of slippages from associate banks, which is almost 80% of the local book.
Pardon? I can't hear you.
You can please tell your name and organization and then.
Can you hear me?
Yeah.
So this is Manish here from Deutsche Bank.
Yeah.
What I just wanted to understand is on your associate banks.
Yeah.
Last year you had more than 60,000 crores of slippages on a loan book of 3,80,000 crores.
Is it? No.
Which is almost.
No. Can't be. How much? This last year he is talking about.
Fiscal 17.
Fiscal 17.
That's right. So fiscal 17, it would be large. It is large because, as I said, their AQR was small. And when we aligned it with our books, that slippage occurred because, they were aligning with the numbers that we had.
But ma'am, that's about 1/5 of your books.
It's quite likely. It has to be aligned with us at the end of the day.
So was it that different?
Yes, it was.
Also their proportion, some of these banks had much larger corporate exposures proportionate in terms of proportion as compared to us. That is another thing. But I think what we would really like to highlight is the fact that we have done a lot of aggressive provisioning and recognition, so that if you see the PCR or the net NPA numbers, even of a merged position, it is in fact not a very bad number given the current conditions.
So basically whatever was there, we have sort of taken it on the chin and rolled with it, so to speak. So everything has been taken, everything has been accounted for, and we have tried to make as much provision as aggressively as possible.
Okay, just another thing on the subsidiary portfolio. So your loan book last year on the subsidiaries is down by about 23%, while a large part could be explained by the slippages. But even if I adjust for that, your loan book in the subsidiary businesses is down almost 10%. It seems that last 6 months or something, there wouldn't have been much business conducted in the subsidiary. And with the merger happening now, does that change?
No, see, the thing is, that is quite normal when you are preparing actually to wind down. Okay, those, frankly, if you ask me, we have tried very hard to keep up people's this thing. Plus, what has also happened is certain portions of their exposure we have sanctioned. In respect of corporate exposure, wherever they had exposure and it was coming up for renewals, they were not taking it anymore. There was no point in them doing another assessment and then taking it on. So in respect of those big, large corporate accounts, their share was actually being done by us. That's also one of the reasons why it has come down. Okay? Because in any case, it would have to be done. No point in doing it 6 times for the same large account. So that also has actually occurred where these subsidiaries are concerned, which is why their actual number has come down, because it has come into our books instead.
Thank you so much.
Actually, for the large corporates, you know, the relationship managers, etc., they were all tagged with our relationship managers, so that, you know, the takeover of the account and the takeover of the thing happens seamlessly as soon as the merger takes place. So that's one of the steps that we took in order to get these whole things aligned as quickly as possible. And I think the right thing under the circumstances. Anything?
Okay.
There's nothing else we can
Close it.
I trust all.
क्या हो रहा है भाई?
Hello. Can I ask a question?
There's one question.
Yeah, please.
Hi, this is Shrey here from Reliance MS. Ma'am, just wanted to understand, given that this year, you know, we've seen a lot of alignment on subsidiaries, be it AS15, be it provisioning, be it recognition.
Yeah.
How should we really think about ROEs when we look at over the next 2 years? Because it's honestly, the debt in the subsidiaries was way higher than what we were expecting. So if you could give us some idea of how should we really think about it?
ROEs will improve.
Ma'am, the
I should tell you simply that the ROEs will improve. Don't worry. I think most of the worries we have taken.
Okay, in that case, ma'am, the other part was you mentioned that the credit cost for next year would be elevated.
Yeah.
When you talk about flat to elevated, are you referring to consolidated cost or standalone credit cost?
No, consolidated. Now whatever we will speak of henceforward will be consolidated only. But consolidated is already very high, so I don't think it will be that high. But more or less, it will not be at the point where we would be quite comfortable with it. It won't be as high for the consolidated as it was this year. This year has been very high. It won't be as high as that, no.
And ma'am, I guess if you can give us some sense about resolutions, how is the ecosystem in the environment now, given that demonetization took away some time? If you could give us some texture there, that would be helpful.
Actually, demonetization didn't really do anything about resolutions. Resolutions, in any case, you know, they need certain dispensations, I think. Even today, I think that is the main thing. And the only other thing that I can say is that by the day, the NCLTs are becoming more active. So, you know, it will either have to come through dispensations or it will have to go through NCLTs. These seem to be the two major options. Or the banks come together and do it in any case. Probably these are the 3 options. So, we'll see how it works. But more or less, there is a lot of government focus now on this, and that already always helps. So, let us see, even on the NCLT front, I think things will start moving very soon.
And ma'am, lastly, are we disclosing the embedded value of SBI Life?
No, embedded value we will come with. Are we disclosing it this time?
It is in the process. But
still under process, yeah. We will disclose it, but it is at this point under process, I think. We will disclose it.
Ma'am, just a follow-up question on your provisioning. So we already have 61% coverage, like on the console NPA, right?
Yeah.
So why are we fearing like more haircuts if things were to resolve?
61% is overall, na? We were saying that on these ones that we want to resolve, as we told you, the top 50, we have 41%. Okay? So on the top 50, I may need a little more. That is where. So the 1672 that I have taken additional is there. So basically on that piece where we feel that, if we can get this done like an ABC analysis, these are the top 50. If you get this done, it automatically brings your NPAs down. So there we may need a little more.
Should we expect it to be around 50%, or it will be upward of like 60%?
See, if they were all 50%, they would all come into S4A, isn't it? If it is not coming there, then it should be 55, 60 maybe. It shouldn't be very much more, yeah.
No, it's
yeah.
You see, provisions are slightly different in the sense that even if the account is resolved and even if the sustainable debt is say 50, 55, 60% outside of S4A, you need to, there is some sort of a double counting in the sense that the account doesn't get upgraded in a DRS. It continues as NPA. So the NPA figures continue where they are till 1 year of satisfactory repayment. So the point is that the provisions have to be, upfront. Bigger provisions will have to come, and after 1 year they get written back.
So basically, if for instance, if you're doing some kind of an instrument, which is a, say, zero coupon instrument or a very low interest instrument, so you'll have to take the NPV provisions. On the other hand, you will also have to take the NPA provisions for the same account. I think that is what you are trying to say. So to that extent, on the same account, you might have to take double provisions, which will get reversed when the account gets upgraded. But till such time upfront, you will need.
Okay, thank you.
Now, I trust all the questions have been addressed. And if we have no more questions, let me end the evening by thanking our chairman ma'am, the top executives, top management of the team, the analysts, the senior management, and all those who attended this analyst meet from this center as well as from Mumbai. And to round it off this Friday evening, we request you to join us for high tea outside this hall. And I wish you all the very good weekend. Thank you very much.